Good day, traders, and welcome to the premium video newsletter for July 15th, 2013. I hope everyone had a great weekend. This is a prime summer heat weather, and we're really feeling it in Southern California area. Let's start off with the fundamentals. This morning, before the open, we had the U.S. retail sales report. The report was disappointing. Americans spend more at retail businesses in June, buying more cars and trucks, furniture, and clothing. But they cut back on many other purchases, a mixed sign for economic growth. Retail sales rose just 0.4% for May, less than analysts had forecast and less than the 0.5% increase the previous month. The retail sales report is the government's first look at consumer spending, so it's a very important report. There's an important note I want to make, especially for traders who are just starting out. Whenever you hear me or anyone else talk about fundamentals, you have to remember the actual number that came out is not nearly as important as how it compares with the estimates. This is why many public companies downplay their estimates, so that analysts can lower their expectations. Then the stock comes out with higher than expected numbers, and the stock rallies strongly. This happens with all fundamental news, regardless if the government or private company is giving the news. Always look at the estimates and how they compare with what actually came out, instead of looking at the released number in isolation. Technically, the stock market was very quiet for the majority of the trading day. However, the market did begin to rally towards the last hour of the trading day after bonds closed. We're officially in a bullish cycle once again, and are close to taking out the high made on May 22nd. The fact that we rallied after a weak retail sales is a very bullish sign. Another important note that works for the bulls is the fact that the rally is not concentrated in a sector or small caps as it was a week earlier. It's now consistently fair across small caps and large caps as well. What I don't like about the US stock market is the RSI, which is not a sensitive indicator. It's approaching the 80 level. Also notice that when the rally peaked on March 22nd, the RSI was at the 77 level, and now the market only lower by a few points, but the RSI is at the 74 level. This is beginning to show some degree of divergence. Let's see how the next few days goes, but the low volume may be pushing the stocks up artificially. The bond market rallied as anticipated. I'm looking for the yield to go a bit lower, which occurs when bonds rally. The main reason the bond market is rallying is because the stock market is showing so much strength in light of the current economic conditions. As soon as the stock market begins selling off, which shouldn't be too long from now, considering the rally in the stock market is being fueled artificially by the Feds spending $85 billion per month on bonds to keep interest rates low and stocks high. Ultimately, the US will have to stand on its own, and when that occurs, interest rates will go higher and bond prices will go substantially lower. We're not there yet, but should begin moving in that direction sometimes in September. Crude oil is on everyone's mind right now, and everyone is trying to explain different reasons why it's moving higher. Some analysts claim prices are higher because the federal stimuli is freeing up money and will create global energy demand, while other analysts are blaming the slowdown in China. The fact is, crude oil market broke out of a long-term resistance area and is moving higher. I can tell you technically that the market has almost no retracement or pullbacks since the run-up. This is a very bullish indication, to say the least. Typically, the less pullback a trend has, the stronger it is, and the higher the chances of its continuing. Technically, the crude oil market has a bit more to go. Consider the 108 short-term resistance area and the 110 area to be a good place to shoot for in the coming days. If you only trade stocks, send me a quick email and I will provide you with a few stocks and ETFs that track this market perfectly. The gold market rallied a few points today and actually came just a few ticks of hitting the 1300 level on Friday. I've been alerting our subscribers to wait till the gold market hits at least 1300 before selling short. I have to say now that we're at that level, and technicals are suggesting that we will be moving higher. If you're considering shorting this market, I would give it a bit more time. I'm shooting for the 1350 level, and it looks like we may actually get there. There's a new inside day long setup on HPQ, Hewlett Packard. Go long on a stop at 26.55, and if filled, place a sell stop at 25.60. I want to give this trade a bit more room because the volatility may be picking up since we are near the May highs on the US indexes. So be careful and watch this stock carefully because it has a major impact on other tech stocks as well as the stock market. It's a very big cap stock. That's it for today, and I'll update you tomorrow morning with the latest. Have a great night, everyone.